We have all heard this advice before. If you invest your money, stay patient and keep it invested for a long time, you will build wealth. That is the reason so many people choose stocks and broad ETF. We expect them to deliver positive returns over time. But here is a question most investors never ask. Will this strategy still work for the next 20, 30, or even 40 years? Or are we relying too much on what worked in the past and hoping it will continue forever? Let's take a closer look. The main reason people invest is the power of compounding. Even small amounts can grow into significant wealth when they are invested over many years. Historically, the stock market has returned about 6 to 9% per year on average. Of course, returns do not come in a straight line every year. Markets go up and down, but over decades, the trend has been strong. The problem is that many investors assume the future will look just like the past. While there are no guarantees, there are several reasons why stocks and ETF are still likely to perform well in the decades ahead. Reason 1. Inflation and the money system. Our financial system is built on inflation. Central banks constantly print new money, which increases the money supply. During the COVID years, more money was printed than ever before in history. When more money circulates, prices rise. Companies pay higher wages and more for materials, and they pass those costs on to consumers. As a result, company revenues and profits measured in dollars or euros also increase. Even if inflation reduces purchasing power, stocks usually protect and grow your wealth over the long term because company earnings grow with inflation. Reason 2. Human consumption. People always want more. We look for new products, services, and experiences. In many parts of the world, billions of people are only now entering the middle class for the first time. This growing demand will likely support company growth, and with it, stock market growth for many decades. Even if growth eventually slows, we are still far from a point where everyone has everything they want. Reason 3. Population growth. More people means more demand. Over the last 70 years, the global population grew from under 3 billion to over 8 billion, and it is expected to reach around 10 billion by the year 2100. This means more workers, more consumers, and more economic activity, all of which support company earnings and stock prices. Population growth might eventually slow, but that is likely beyond most of our investment horizons. Reason 4. Innovation and technology. Innovation is another powerful driver of growth. Every decade, new technologies such as the internet or artificial intelligence change industries and create new opportunities. As technology improves, companies become more efficient and more profitable, often with fewer resources. Innovation is one of the strongest long-term growth engines and a key reason why markets can continue to rise. Dividends, buybacks, and value creation. Even if economic growth slows or stops, companies can still create value for shareholders. Imagine a farm that produces apples. It sells each apple for €1 and makes 50 cents in profit. If the farm becomes more efficient, it might reduce costs and make more profit even without selling more apples, or it might return those profits to shareholders as dividends. Companies can also buy back their own shares. This reduces the number of shares available and increases earnings per share, which can push stock prices higher even in a low-growth environment. Risk and return. At the core of investing is the relationship between risk and return. Investors take on risk when they buy shares in a company, and they expect compensation for that risk. If returns become too low, investors will invest less money. Companies will then need to offer higher returns to attract new capital. This self-correcting cycle is one reason stocks tend to offer positive returns over the long term. Realistic expectations. Will we continue to see 8 or 9% returns every year? Maybe not. Future returns might average 5 to 7% instead, but even that is powerful when compounded over decades. And let's be honest, if stock markets perform far worse than expected, then most other asset classes like gold, real estate, or bonds will probably struggle too. In that case, we would have much bigger problems than our portfolio returns. Final thoughts. No one can predict the future, but history, economics, and human behavior all point in the same direction. Stocks and ETF remain one of the most reliable ways to build wealth over the long term. The key is consistency. Keep investing, stay patient, and ignore short-term noise. If you want extra safety, diversify your portfolio with assets like gold, Bitcoin, or real estate. What do you think? Will ETF continue to deliver strong returns in the future? Let me know in the comments. And don't forget to like, share, and subscribe for more finance and lifestyle insights with me, Lola.